Picture this. A world built on decades of predictable order is now shifting beneath our feet. You're used to seeing the same flow of trade, the same alliances, the same assumptions about power. But what if all that is changing? What if the rules we took for granted are fading into the rearview mirror? Today, we're diving into a warning from Lawrence Wong, the Prime Minister of Singapore. He says we are in the midst of a great transition, a post-American world, where the stabilizing hand of the United States is no longer guaranteed. That is not just a geopolitical footnote. It has serious consequences for global trade, investment, and for anyone watching global markets from the sidelines. And yes, you and your portfolio. Why does this matter? Because Singapore is one of the most open, trade-dependent economies on the planet. It has built much of its prosperity by operating at the center of the global system. So when Singapore's leader says the rules are changing, we all should pay attention. Let's unpack what he means, why it matters, and what we should watch. I'll take you through 3 parts: the landscape of change, the implications for finance and trade, and finally what this means for you as an investor or someone trying to understand where the global economy is headed. The post-1945 order was largely anchored by American leadership: military, economic, diplomatic. For decades, the U.S. served as something of a global guarantor of stability. But today, Wong argues, we are in a transition. We are certainly in the midst of a great transition to a multipolar world, a post-American order, and a multipolar world. Notice those 3 elements: great transition, post-American, multipolar. When you hear multipolar, think of multiple centers of power rather than a single dominant one. Think of chessboard pieces being repositioned rather than a king moving alone. It's messy. It's unpredictable. It doesn't come with a clear rule book. He says, no one can tell how the transition will unfold, but there is no doubt it will be messy and unpredictable because America is stepping back from its role as global insurer, but there is no other country that is able or willing to fill the vacuum. Why post-American? Because the U.S.'s role in providing global public goods, security, open trade rules, stable currency regimes is under strain: domestic politics, strategic fatigue, competing priorities. And as that role recedes, others are stepping in, existing rules are under stress, and new ones are not yet written. For Singapore, this is especially salient. The country thrives because it sits at global intersections: shipping, banking, trade, logistics. So when the broader order becomes less certain, Singapore's exposure becomes higher. Wong acknowledges this. The Singapore economy is like the canary in the coal mine. Because we are so open and exposed to the external environment, we are the first to feel it when the external environment starts to weaken. Let's translate this from high-level geopolitics into something more concrete. First, trade flows. If one of the big assumptions, that trade remains open, predictable, rules-based, starts to wobble, then so do supply chains. Wong points to changes, such as tariff pressures from the U.S., reconfigurations of supply chains, and how firms are reacting. In other words, disruption. Second, investment decisions. If the future becomes less certain, companies may slow down or hold back. Wong mentions Singapore is already seeing business investment softening. For you watching, that means risk premiums start to rise, capital may shift, pricing may change. Third, the geopolitical overlay. It's not just economics, it's power. Regional players, strategic partnerships, export controls. For example, Singapore finds itself balancing between the U.S. and China. Wong says China is not yet a full substitute for the U.S. in terms of global leadership. It has strength, but it also has significant internal challenges. So what you have is a world where power is more distributed, competition is sharper, and alliances less predictable. Think of the old global order like a major freeway network. Well-paved, well-signposted, everyone knew the exits, the tolls, the rules. Driving was predictable. Costs were known. People planned routes, investments, infrastructure with confidence. Now imagine major construction zones, detours, new tolls popping up, lanes shifting, new roads being built, but no roadmap yet. That's what we're entering. The highway model doesn't go away overnight, but the shortcuts, the efficient lanes, the assumptions, they falter. Singapore's PM is basically saying, buckle up, we're entering the construction zone. We're not sure which lanes will open or close, which tolls will rise, which new roads will emerge. One might ask, isn't this just a small country talking? But Singapore punches above its weight in global trade. It's one of the most globalized economies in the world. Wong's warning matters precisely because Singapore sits at the nexus of global flows: trade, investment, logistics. If they're seeing turbulence ahead, it's not idle talk. Also, Singapore's approach is pragmatic. Wong does not claim to have all the answers, but he emphasizes action. We cannot afford to just wait for things to happen. We have to take actions now, plan now. That's a mindset shift, not reactive, but proactive. Singapore is also trying to shape the new environment, for example, by strengthening trade relationships with like-minded countries, working towards new frameworks. This suggests the global economic order may fragment into smaller blocks or networks, less centralized, more heterogeneous. As Wong notes, if the U.S. no longer underwrites the global system in the same way, who fills the gap? Or is the gap going to remain? He believes no one is ready to fully fill the vacuum. What happens when global trade arteries get clogged or rerouted? How will supply chains evolve when geopolitical risk becomes part of the cost? For investors, in which sectors or geographies do you reduce exposure? In which do you increase? How do you assess risk in a world where the rules are in flux? Now that we understand the warning, let's dig deeper into the mechanics of this transition. What does a post-American, multipolar world actually look like for trade, investment, and economic strategy? And why is Singapore, and by extension the global economy, so sensitive to it? Imagine trade as a vast, interconnected web. For decades, one strong hub, the United States, kept this web taut and predictable. Rules were enforced, disputes mediated, and global markets operated on a known set of principles. But as Wong points out, the U.S. is stepping back from this role. What happens when that hub loosens its grip? First, trade friction increases. We're already seeing regional supply chains adjusting. Companies are diversifying away from dependency on any single country. Manufacturing in one region, sourcing raw materials from another, selling globally. Every link is now under scrutiny. For example, tech companies in Asia are facing new constraints on exports, particularly around semiconductors. The U.S. has introduced restrictions on technology sales to certain countries. Simultaneously, Europe is reshaping trade agreements to secure its own supply chains. Meanwhile, China is creating alternative corridors through initiatives like the Belt and Road. The result? A world where trade is less centralized, less predictable, and more fragmented. Wong's caution isn't abstract. It's grounded in what Singapore's businesses are already feeling: higher costs, slower movement of goods, and the need to navigate multiple competing rules simultaneously. If trade flows become less predictable, investment patterns shift. Investors demand higher returns for taking on uncertainty. Countries or regions with less predictable policies now see higher borrowing costs. Companies hesitate to commit long-term capital. Singapore, despite its stability, cannot fully insulate itself from these global forces. Not every sector suffers equally. High-tech and strategic industries, semiconductors, green energy, cybersecurity, may benefit from localized supply chains or government incentives. Commodities and traditional manufacturing may face pressure from increased tariffs, transport costs, and political risk. Stock and bond markets often overreact to geopolitical uncertainty. Wong emphasizes planning, hedging, and flexibility. This translates to portfolio strategies. Diversification, geographic spread, and scenario planning become critical tools for both institutional and retail investors. Wong's insight that no one is ready to fill the vacuum is crucial. It means power is more fragmented. Think of it as a chessboard with multiple strong players. None fully dominant. China, while powerful, has internal and external limitations, slowing growth, demographic challenges, regional tensions. The European Union has economic heft but lacks military reach. Emerging economies have influence, but global coordination is uneven. Singapore's task is clear: navigate carefully, maintain relationships with all major players, strengthen regional partnerships, and avoid being forced into zero-sum choices. For global investors, this signals caution. Political risk is increasingly a financial risk. The pandemic already revealed the fragility of global supply chains. Add to that the post-American uncertainty, and companies are aggressively redesigning logistics. Firms are bringing production closer to home or into politically aligned countries. Instead of relying on a single supplier, multiple suppliers across regions reduce dependency. Automation and digital platforms help mitigate risk but require upfront capital investment. Currency stability is another concern. Historically, the US dollar has acted as the global anchor. If American influence wanes, alternative currencies may emerge. Wong highlights the risk. Sudden shifts in currency markets could destabilize trade, and finance investors need to ask, how exposed is my portfolio to dollar-based risk? Could other currencies, euro, yuan, or even regional digital currencies, gain prominence? Wong's warning isn't meant to incite panic. Instead, it's a call for strategic thinking. Expect the unexpected. Build resilience. Monitor policy shifts. Embrace flexibility. Scenario planning, agile supply chains, and adaptable investment strategies are now essential. Think of global economics as sailing. For decades, the U.S. provided a steady wind that filled the sails of international trade and investment. Now, the wind is shifting direction. Some sails may catch it, some may falter. Singapore is like a small but highly skilled crew. They can adjust their sails quickly, but even they cannot control the storm entirely. Real-world examples make this clearer. Take the semiconductor industry. Companies like TSMC in Taiwan and Samsung in South Korea are strategic actors. The U.S. has imposed export controls. China is accelerating domestic capabilities. Singapore is deeply integrated into this global electronics supply chain. A disruption here ripples through multiple sectors: automotive, consumer electronics, even finance. Singapore's port is among the busiest globally, but rising tensions push companies to explore alternate routes. Wong's warnings hint at a bigger lesson. When global power centers shift, infrastructure and logistics must adapt before disruptions arrive. Global capital flows are sensitive to uncertainty. Investors are recalibrating risk models, hedging against currency fluctuations, and reconsidering exposure to politically sensitive markets. For the first time in decades, financial stability depends not just on central banks or U.S. policy, but on a network of actors: regional powers, multinational corporations, and emerging economies. Turbulence isn't just risk, it's opportunity. Diversify investments across regions, sectors, and asset classes. Look for strategic sectors: technology, renewable energy, logistics. Invest in flexibility. Monitor geopolitical signals. Being informed early can mean first-mover advantage. Singapore's strategy is instructive. Wong emphasizes preparation, diversification, and proactive engagement. The city-state invests in resilience, from infrastructure to human capital, while maintaining diplomatic balance among major powers. For businesses and investors, the lesson is simple: act before crises hit, anticipate change, and avoid dependency on a single actor, market, or currency. We are witnessing a fundamental transformation in global order. The U.S., long the stabilizer, is ceding dominance. Emerging powers are rising, alliances are fragmenting, and economic rules are being rewritten. Singapore's Prime Minister warns of turbulence because he sees what many cannot: the early tremors of systemic change. For you, whether an investor, business leader, or informed observer, the key takeaway is not fear, but awareness and action. Anticipate change, Diversify your exposure, invest in resilience, and watch closely where new opportunities emerge. The global economy has always rewarded adaptability. Today, that lesson is more important than ever. If you found this analysis insightful, hit the like button and subscribe for more deep dives into the forces shaping our economy. Share your thoughts in the comments. How are you preparing for a post-American, multipolar world? And don't forget to watch our other videos where we break down complex financial and geopolitical trends into actionable insights you can use. Stay informed, stay strategic, and as always, think like a financial economist.